Good morning, everybody. Thank you for joining us today. We're going to be getting started in just a few minutes. In the meanwhile, while you're waiting, if you go to the chat screen, you can go to the Q&A and you can go ahead and put in any questions that you might have today for our presenters. Okay, it's 8 o'clock, so we're gonna go ahead and get started. Today's webinar is being presented by Smith Marion and Company. We're an accounting firm with offices in California and Tennessee. We specialize in housing authority audits, nonprofit audits, 990 tax returns, and business and individual tax returns. Before I introduce our speakers, just a few housekeeping items. We're going to be recording today's webinar. You'll have access to the webinar and the slide deck after today's presentation. Any questions and comments are welcome. You can feel free to put them in the Q&A box, and I'll either stop the speakers if it's appropriate for that time, or I'll hold it until the end. I'm Hannah Baldwin. I'm the firm administrator at Smith Marion and Company, and I have with me today Chad Porter and Doug Englehart. Doug is a partner at Smith Marion and Company. He has his Master's of Science in Accountancy from Cal State San Bernardino and is a licensed CPA. Doug is well-versed in the affordable housing authority industry, including housing authority with LIHTC and not-for-profit component units. Doug values partnering with his clients and delivering a quality audit that brings them value. I also have with me Chad Porter. He's the CEO at Smith Marion and Company and works out of our Tennessee office. With over 25 years of housing authority experience, he's an expert in HUD accounting. Chad is also a fraud investigator and a licensed CFE. He actively makes recommendations to his clients on how they can strengthen their internal controls. Passionate about the industry, Chad keeps up with ever-changing accounting regulations for housing authorities and actively looks for opportunities to share this knowledge with those in the field. And with that, I'm going to turn it over to our presenters.
Morning, everybody. So table contents here, we're just going to kind of start off with, and we only have an hour, and everyone knows I can talk fast, but I don't know if I can talk that fast. But we're going to try to cover these 4 major areas that we just want to kind of bring everyone's attention. We're trying to do these quarterly webinars, keeping people up to date because we can't get to everybody all the time. There's only me and Doug, and we can only be so many places at one time. So we're going to cover a little bit about your FDS, some of the changes, some of the key issues we're seeing on rejections, hopefully trying to keep you out of the rejection pool or get you out of the conditional acceptance pool and over to that beloved approval status. Then we're going to talk a little bit about RAD and LIHTC. Anybody who's in those areas knows that's a complicated area. We could spend over 2 hours just talking about that one, but we'll just spend a brief overview in those areas, kind of highlighting some areas that we wanted to bring to your attention. And then another hotspot, of course, CARES. Reporting, mostly we're going to focus on. So I'm not going to focus much on, we've done plenty of seminars. You can go back and watch old webinars that we have about what's allowable and not allowable on CARES. But this one's going to focus more on the reporting issues we're seeing inside of REAC and the FDS and common errors. So it'll kind of tie into one, but more focused on the CARES because we have lots of problems in those areas. And then we're going to touch on MTW since the first cohorts are going to be converting over, and the second cohorts are going to get released pretty soon on who's going to go MTW, and just talking about how it makes additional work for your accounting staff. Make sure you are planning for that and you're ready if you're going to go MTW, or if you're considering it, make sure that's in your consideration too. Anything you want to add in there, Doug? I'm missing on kind of those highlights.
No, I think when we get into it, we'll have lots to talk about.
Yeah, like Doug said, he said, "You think we can get all this done in an hour?" I go, I hope we can. We'll see.
We'll still be on section 1.
Yeah, we'll be on section 1, and we're 45 minutes in. We'll try to get through all this stuff. So section 1, we're going to talk about FDS and making sure you fix some of these things that we see happen. And we're guilty of them too. We train our staff members in these same areas that are now the hot spots for HUD. Sometimes they're new. They just changed their checklist. What do you think, Doug? Maybe 6 months ago, a year ago, they changed their checklist, and it's been causing us problems.
Yeah, it depends on what checklist they're looking at and then what analyst you're getting, you know, whether you're getting someone on the West Coast or East Coast, and certain people have their own little hot button items.
So let's jump into that first slide and kind of go through some of the things that we're seeing. So one of them, and we're going to talk kind of briefly about it, but we'll cover it a little more in depth, is the CARES funds. If you're not aware, when you roll your FDS forward, it's just going to put in the programs you had in the prior years. So if this is your first year with CARES funds, you have to physically go in and add that tab to your unaudited submission or your audit submission. And I'm sure Doug's seeing the same thing I am. One of the problems we're seeing with the CARES funds is it's mixed in with either your HCV program or your public housing program, and they want it reported separately on the FDS. So we're seeing a lot of housing authorities mix that in and cause lots of problems. So Doug, on that one, I'm generally having them do journal entries to move it out. Is that what you're seeing too?
Yeah, or I mean, if they have the account set up and it's all in the same fund as HCV, but they identify, hey, this is CARES revenue, this is a CARES expense, we can pull that out as a separate fund. And I won't make them do the journal entries, or I'll do a RJE and just talk to them about it and say, hey, you know, you really need to keep this in a separate fund. I'll do a RJE because you can show me where this all needs to go. And I mean, you don't need a journal entry, you know, your books will be all right. But yeah, keeping these things in a separate fund, and when you go in and do the REAC, you're not going to have just 14.871 for section 8, right? You're going to have 14.8 CC, and then you might even have these emergency housing vouchers. As of 6/30, saw the 6/30 REACs that we've been doing. They haven't spent any of the emergency housing vouchers, right? But they've gotten some of the cash. So you have to go set that, you know, column up and make sure you're accounting for that in accordance with the new PIC notice. So in case you guys don't know, there's a new PIC notice for emergency housing vouchers. It's a PIC notice 2021-25. And there's a lot in that particular PIC notice. So definitely, if you got emergency housing vouchers, you want to become familiar with that PIC notice.
Like Doug was saying on that one, a lot of our June 30 housing authorities received funds, but we advise them not to even try to spend it in June because there's nowhere on VMS to record the expenditures. July, they released a tab in the VMS to record now your emergency EHV money. So I think you've ran into that, Doug, right? I mean, basically, if you're a June 30 client, you should have cash and deferred revenue or unearned revenue for your
restricted cash
fund.
Yep. Exactly.
Yep.
113 and 342.
Yeah, I'm gonna say make sure you use those lines too, because if you put it in unrestricted cash, you'll have problems also. So those are the big, those ones are new programs that we're having to put on. And then there's the Ewrap, if anyone's getting some Ewrap money, which is different than, it kind of at first confused me. I don't know if Doug was confused by it, but it threw me off first when there was 14 point EHV, which is emergency housing vouchers. And then there's Ewrap, which is emergency rental assistance program. I got, okay, wait a second, hold on. These are two different programs. One is going to come from the Treasury Department, and the other one is going to actually come from, your HCV, HUD, VMS kind of methodology of funding the money down through. So be aware if you get any of those, a lot of times the Ewrap is coming to the states or the city, and they're subcontracting with you as a housing authority to provide that service. I have a few housing authorities that have gotten that money as a sub award, which has a whole nother set of headaches, but obviously make sure you keep those separated. Don't get confused because they're all kind of like, they all kind of look and smell like vouchers. So people are merging all that together, and you need to keep it separate because the FDS is going to be looking for that information to be split out. Any other programs? I don't think there's any other programs I'm missing, am I, Doug?
No, well, you got the COCC, so you got the 14-point CCC. So that's just the extra management fees and all that you can charge above and beyond the normal rate. That one's missing off of there.
How much do you like doing that one, Doug? How much do you like when your housing authorities do that?
Yeah, they all try to do it a little bit differently, you know, through transfers and all that stuff. So it's a fun one to tackle. But just one thing on the emergency, the Ewrap money, that's not from HUD. So you're not going to have a pick notice. You're not going to have HUD accounting guides. That's coming from the Treasury. And there's no REAC. There's not going to be any REAC reporting guidelines from the Treasury because REAC's obviously from HUD. So just keep that in mind.
Yeah. And there is, I think, I'm pretty certain, I had to ask Cole, I can't remember, one of the Treasuries has a compliance supplement and one of the Treasury funds doesn't, but I can't remember which one it is. I think this one has a compliance supplement, so we would at least have some guidance from OIG on how to audit that information. Okay, so we're trying to get through these. Let's keep moving. The CARES funds, this is one of the common errors that we see when we're talking about the reporting. Doug just mentioned it. Make sure if you have leftover CARES funds, it's in cash 113, restricted cash, and 342, which is the credit side, which is going to be your unearned. Some people call it deferred. We can't use that word anymore. So it's the unearned portion of your grants. So make sure those equal each other. HUD's expecting to see that because when that money came in originally into your general ledger, that should have been the entry that you made, cash and unearned revenue. And as you spend the cash, then you can recognize that revenue along with the expenditures. The balance sheet and capital assets is one that we see a lot of times. What they're talking about on there is if you're spending CARES funds, you can't have fixed assets in your 14 point, whatever letters are after it, PHC, HCC, any of those cannot have a fixed asset balance. Those have to be transferred over to the corresponding program. So 14 point PHC would have to be transferred over to public housing. 14 point HCC would have to be transferred over to the voucher program. Are you seeing that, Doug? I mean, a lot of my clients aren't moving that money. We have to do it for them.
Well, yeah, not the money, but the fixed assets. They would, you know, and I've had questions where they wanted to put it in the COCC because they bought some computers or, you know, some communication equipment, and they say, okay, well, I use my Section 8 money to purchase that, right? The CARES Section 8. So I'm going to move it over to COCC. You can't do that. You can't move federal funds over into the COCC because the COCC is unfederal. So if you bought it with the HCV CARES funds, it has to move into the HCV program, and that's where it's going to stick. You can't move it into the COCC. And same thing with public housing. If you bought it with public housing CARES, it's going to stick to the public housing, and that's where you're going to account for it in those funds.
Yeah, and be sure to make sure, like Doug said, if you try to do what he was describing, where they're trying to make it with the CARES HCC monies and try to send it over or transfer it over to COCC, you'll get an automatic rejection. They will not accept that. Hopefully your auditors catch it too, but you know, we're talking about rejection issues. That's maybe sometimes on your unaudited submission, they'll get rejected too. So that's most stuff we're telling you too. You might say, well, the auditors catch that a lot of times, but we're trying to help you with your unaudited submission also to get away from getting rejections there too. CARES funds, they expect revenues to equal expenses, no net income. That was a big thing in the notice when it came out. You cannot carry these funds over. They can't show net income. That's, I mean, when you buy fixed assets, that's what happens is you do show capital revenue and no expenses because the capital asset is a balance sheet entry. And so you would end up with net income. That's where these transfers come in that we were talking about. You have to transfer that revenue over to another fund through equity transfers. And then the PPP, all the stuff that you did, the masks and things like that, they want that tracked on the 924 line. And maybe you want to expand on that, Doug. I mean, I don't want to talk too much about what goes on the 920 lines, but the difference between 920 lines and putting it on all the other lines, how they're supposed to report those extra costs.
I think the general idea that HUD had is that, you know, because they had the regular HCV expenses or public housing allowable, right? This was allowable prior to CARES, right? Any of that stuff you put on the normal FDS lines. If it was allowable prior to CARES, you know, the release of buying all this extra stuff, put it on those lines, salaries, you know, benefits, any of that kind of stuff. Those go on your regular FDS lines. This line, it's going to be under, it's the tenant services other expense line, right? That's the line that they want you to code anything that wouldn't normally have been allowed, right? So you're having to pay for all these masks and you know, weird kind of things that are just associated, right? What are the three things for
prepare? I forget the 3 P's.
Prepare, prevent, yeah, those three. So if you're familiar, if you've done any CARES seminar, you know the 3 P's. That's where where they want it to go, so they can see how much you spent on that.
Yeah, included there would be like your barriers that you're putting up. You know, those plastic barriers. A lot of people are buying kiosks, you know, touch kiosks, so they don't have to. They can fill out applications on the kiosk and not actually deal with staff members and keeping the social distancing. Those are the things that would go in that 924 line.
If it's below your capitalization threshold.
Yes, good point, Doug. All right, let's move to the next one. Emergency housing vouchers. This is kind of quick and easy because as of June 30, which is most year ends right now, your September 30 ones, you guys will be able to have some of this expenditures on your submission. I guess for your September 30s and December 31 clients on your unaudited submission, if you've got these funds, these 14-point EHV funds, like Doug was saying, either consider setting up a separate fund or coding it inside of HCV so that's very easy to stand out. I would probably argue to make a separate fund because there's going to be a separate tab on VMS. So they're going to have, you know, all your HCV on one tab expenditures, and then another tab in the VMS system is going to be for the EHV system.
Right. And so just to add on that, because I was reading through, trying to wrap my head around this new PIC notice for EHV. So EHV is kind of going to be its own, you're going to have separate VMS, like Chad was saying. So you're going to have to put all that information into VMS separate from your Section 8. And you're going to have a whole admin fee. So the things that we were talking about earlier with the Section 8 and the Public Housing CARES Act, this EHV is going to be different. You can have revenues and not matching expenses. And there's 4 different type of fees, admin fees that you can get. You have a preliminary fee, a placement fee, ongoing admin fee, service fee, all these admin fees. And only certain ones you can use. I think it's the ongoing admin fee you can use for your COCC fees. So this whole PIC notice and doing emergency housing vouchers, that can be a whole another hour-and-a-half, 2-hour seminar. So you definitely want to read that PIC notice. It's 2021-25 and start getting that into your brain of how you're going to account for that and track these funds.
I definitely want to set up some time to talk to your fee accountant or your auditor, kind of make sure you got this don't treat this as just another funding stream. Like Doug's saying, that PIC notice is very detailed on what they want, especially with those admin fees and tracking that. If they're putting in the PIC notice, you know they're going to be looking for that information. I imagine, I haven't seen because it's not on detailed enough on the FDS yet, but they're probably going to add lines looking for that information to break it down. And then alongside with what he was just saying, you have to track your unrestricted and restricted. And it looks like the restricted is going to be even more tracked because unrestricted is going to be more tracked than before. Before you just kind of had your admin fee and you could spend it on whatever for admin. But now they're saying, hey, only some of this can be used for, you know, COCC fees, and some of this can only be used for that. So it's going to be more fun, I guess, is how we can describe it. And the last one we're going to talk about is the Ewrap. It's a new program, so you need to add it to your submission because some of you might have had the CARES funds carried over from last year because CARES funds have been around for at least a year. You'd have to be kind of a little bit behind on your REACT submissions to not have added it to your submission at all. But this one is going to be a new one, and it's kind of weird because it's a 21, not a 14. which, like Doug was pointing out, is from the Treasury, not from HUD. And again, they're not going to give us any guidance on how to report this in REAC, because that's Treasury. They don't care. They don't even know what REAC is when they give you this money. And plus, like I was describing before, it's a pass down. You're not probably going to get this money directly from Treasury. It's going to come from the state or the city. You're not going to get it directly from the Treasury, most likely. I point out that you probably should put on line 708 because it is a federal dollar, but it's not from HUD, and HUD generally reserves 706 for their money that they gave you. So if you're not getting your money directly from HUD, they expect it not on 706, they expect it down on the 708 line. And then of course that would correspond with if you have a receivable from them. 124, I can't remember exactly what that line is called. Do you remember, Doug? But 122 is HUD's receivable. What's 124 is, I think, other governments, right?
Other governments.
Yeah. So you want to identify, it's not 706 and 122 identify as HUD. And so you want to put it on non-HUD, which is 708 and 124 if you have a receivable set up for that contract. I think that's pretty much it on those items. And I think that's kind of, if you go to the next slide, I think that's the biggest new programs added. But here's common rejection ones. And these ones we see all the time. And I just went back through them, like the last 10 rejections we've gotten, which didn't go very far back. We get rejections all the time. The net position, HUD calculates that net position. For most of our clients, this usually isn't a problem because we've added to our notes of the financial statement how we're calculating investment in capital assets. Basically is taking, your restricted, you're taking your fixed assets and subtracting off depreciation and showing that less any debt down at the bottom. And HUD takes those lines and tries to do that same calculation. If they don't match, they tend to reject. I don't think fixed assets is the biggest one we have problems with. Generally, I would say, Doug, it's the restricted assets is where we run into most of the problem. Absolutely.
And then that's one of the things I wanted to bring up is that I've had a couple rejections now where they had negative unrestricted net position and it was higher than the pension. So if you have negative unrestricted net position for any of your FDS columns, and it's more than if your pension and your OPEB, they're going to want an explanation, or they're going to reject you because they want to know, why is this particular column so negative and it's unrestricted? They understand that the pension and the OPEB has been forcing, all of these housing authorities to report negative unrestricted because that liability is so big. But if your unrestricted is more negative than however much that OPEB and pension liability is, you're going to want to go into that comment section and add a comment explaining why you have that negative unrestricted net position.
And probably also what's your plan to fix it? Because that's the question they always ask when they reject. Mm-hmm. What's the plan to fix it? So lay out a plan to tell them how you're planning. It could be a 2-year process or whatever, but at least address it. CARES funds, on that one, just they will check that the ELOCs on public housing CARES funds match. And you've heard our seminars before. It's treat it like CFP. We draw down the money as we spend it on the public housing side. On the HCV side, they drop that money in your bank account. So they're expecting that number that they dropped in your bank account to equal what's in the 706 and the 342 line, which is revenues and unearned revenue. So basically they know they gave you $1 million. They expect to see that somewhere by calculating it on your FDS. It's okay, they put $800,000 through revenue and they put $200,000 in unearned revenue. Great, it matches. If it doesn't match, definitely getting rejected. And that's probably, I would say, Doug, of all these on the list, that column right there we're talking about is the #1 thing I get the most rejections on, especially unaudited.
Yeah, when the clients are preparing their unaudited and they haven't read the PIC notice, they don't understand what HUD's looking for on these particular lines. So it's real easy just to be like, well, we got all this money and it's sitting in cash, and we have this much in equity or whatever. No, you don't have any in equity. You have cash and a liability. So that's why you got to keep up with the PIC notices.
Or bug that fee accountant or auditor. And also, like Doug was saying, that be careful on those. I mean, a general rule that we use in our office is that there should be nothing on the balance sheet for the CARES funds except for cash and 342. So if you look down that FDS line, I mean, that column on the FDS and any of the CARES funds, and you see anything in there, I don't care what number you're saying. Doug's used equity. I've seen people put fixed assets on there. I've seen, well, you could have receivables. I will say that you could have a receivable, but no inter funds, none of that stuff. Don't put that stuff on there. You need to go back and look what's going on with those transactions and fix them, because I was saying that's probably 80% of the rejections right there is the CARES funds. Mm-hmm. This one's probably one of our internal ones, but also I've seen clients make mistakes here too. They're looking for the unit months leased and the unit months available. First of all, don't ever make the leased amounts greater than the available amounts. That's impossible. You can't have more units leased than you have available. So that's one of the ones you should always check. The A should always be greater than the L. Don't do it the other way around, because that will trigger HUD to reject you. And then they expect, if they see something on the FDS line 703, which is rental income, they expect something in the unit months leased and available. So you have to put something there. They're saying if you have tenant rent, you had to have unit months available and leased. It could be 5, it could be 10, it could be 100, I don't know. But if you have nothing there, they will reject you.
Absolutely.
Then eliminations, make sure you do your eliminations. As auditors, we build it into our schedule. It's done as part of our audit procedures, but a lot of times our clients forget to do it on the unaudited submission. They forget. Most commonly forgotten one is transfers in and transfers out. Obviously the most commonly used one. If you have transfers in and transfers out, I know they net each other out, but HUD still expects you to eliminate those amounts. Most people catch the due tos and due froms. We've started moving towards wiping out due tos and due froms through cash, using pooled cash if you have it, to get rid of that. I mean, we get so many rejections about the inter funds are too large compared to the other assets and liabilities of the fund. You really shouldn't have due to, due froms unless you just don't have enough cash. And then of course that's red flags to HUD in the first place. And that's why they pick so hard, I think, on the inter funds. So our internal rule kind of is, if you can get rid of internal funds, we say at year end, please clean those up and transfer the cash around so that it makes everybody's life easier, yours and ours. And last but not least, the 707, which is the COCC revenues, should definitely be eliminated against the 913 and 920 COCC fee expenses. Anything else on that one, Doug?
Yeah, just a couple other nitpicky ones that I get from some of my analysts are, if you're showing debt, if you're showing long-term debt and not current debt, they're gonna want an explanation. So if you got long-term forgivable loans and you're not showing a current portion, or maybe just interest only loans that you only pay interest and then you have a balloon payment at the end. So if they see something down a long-term, ask questions. So maybe you just attach your notes payable note disclosure into the comments, and that way they can see, okay, these are all long terms that don't need any current payments on them. If you do have a current portion, down in the very bottom of the P&L part, you're going to want to put the required debt payment line. You want to put something on there for how much you paid during the year on that debt, the principal that you paid on that debt. Because if you have a current portion, then obviously you're making payments on it, and they're going to want to know how much you paid on it for the year. So I've gotten some rejections on that. And then another one that I've gotten rejected on twice, and I have a lot of other places that don't quite show it like this, and I don't know if it's new to the checklist or whether the analyst is just getting nitpicky, but your transfers between amps needs to be on I forget what FDS line, but it's an inter project cash transfer FDS line.
It's like 193 and 2, I think.
Right, 93 and 9, yeah, those ones. It says inter project cash excess cash transfer. That's what you have to use for in between the amps. Now, if you're transferring, from the COCC to the public housing, or from business activities, any of those from program to program, that's going to be your 100 or your 1001 and your 1002, right? Your operating transfers. That's what's up there. So I've had an analyst reject me for transferring between amps using the the operating transfer line instead of the project excess cash transfer line.
And I would say probably the last one to make comment on here is that a lot of my March 31s don't get too excited. A lot of them got conditional accepted. It says, if you read it, they didn't review anything. They just conditionally accepted it.
I got one of my 630s, the one this morning. So I think 630s are probably
still doing it then.
Too. Yeah.
Yeah. So that is no help to us because that means we got the one shot at the audit. We prefer them to, at least review the unaudited so we can, any errors they find there or anything they have problems with there, client specific, we can address. But when they do that, that really kind of puts handcuffs on us of like, okay, well, we'll use our knowledge and try to get it the best we can. Okay, next one's Rad and Litech. So this one is probably just me and Doug probably built the whole seminar, started from here. If you're creating component units, talk to your auditor, talk to your fee accountant. Don't wait till year end. There's two reasons for that. I would say my big two reasons is one, we come out expecting to audit what we saw last year. So a lot of times we don't know you've created these entities and we don't allot time to do that work. I know there's going to be a fee associated with it and we're trying to leave that little dirty part off at the side, but we need to be prepared to audit additional stuff if you've done it. Also, I had a housing authority who took their total RAD conversion and that's all they had in public housing and inside the housing authority and created a separate nonprofit and did PBRA and was shocked whenever they kind of found out that they left all the housing employees in the housing authority in their COCC or business activities and were charging them over to the nonprofit. And now they had to have two audits because the multifamily housing audit for the nonprofit was one, and the housing authority still had activity with the employees in the COCC and the pension. So that still has to be audited too. So their fee we didn't double their fee, but it was close to double because now they have two audits and two reports. And we have to do two sets of work papers or under two different standards, two HUD guides. I mean, the multifamily housing guide is different than the public housing guide and the housing authority audit guide. So we have to have two sets of work papers. We have to have two reports, which means pretty much double the work for us. So that means close to double the fee for you. So for us, this point here mostly was to bring up as you're being approached by developers and you're doing these things, we don't want to shut you down. It's great. I mean, this is the future of where housing authorities are going. So don't get us wrong that we're saying don't do them. But as you're doing them, you need to be in contact with your accounting people, and that's your fee accountant, your auditors, to get their input or knowledge. We see a lot of these. I don't know what you want to throw in there, Doug, but I know this is one that we talk about on a regular basis between the two of us.
Absolutely. So, you get into these deals, you have your developer and you have your lawyer, and you don't talk to your accountant. The lawyer, he can get the entity created, right? So now you got a new separate legal entity and the developer can get you these deals and they're not going to talk to you about any of the accounting implications, how to set up your funds, going through the whole component unit flow chart that GASB has to determine whether, this potential component unit, is it a discrete? Is it a blended? Is this just a joint venture that you're getting into, right? So if you want to look into that, it's GASB 61 has a component unit flow chart. It's a chart in there that'll walk you through a potential component unit at the start, and you make all these decisions on the decision tree, and it'll tell you whether that's a blended component unit, discrete component unit, or a joint venture, or just nothing to you guys at all, right? And I would highly recommend having that for any legal entity that you create. If it's a legal entity that you created, chances are it's either going to be a discrete or a blended component unit if it's a legal entity that was created by the housing authority, right? But then also you might get into partnerships too. So you want to put that partnership, you want to flow that through the flow chart too, because your nonprofit might get into a partnership, tax credit partnership with these guys. You got to let us know. You got to figure out, where is this? Does this need to go on my financial statements? Does this need to get brought under my umbrella of my housing authority? Or is this just, hey, I'm just managing, these units for an outside agency. We don't tell them what to do. We just take care of the units. We just get a management fee, right? That's different than, hey, we own this nonprofit that owns these units, right? So now, this is part of us. We make all the decisions. So the legal entities that you created, I would say get that GASB 61 flow chart and go through every entity and get your determination. And that way, when your auditors, your accountants show up, we're knowledgeable. We know what we're doing. This is how we outlined it. Let's figure out how to account for it.
One other thing to throw in there too, as Doug said, you'll know you create a separate legal entity because it'll have its own EIN number, which also brings along tax implications.
Mm-hmm.
So if you're creating partnerships and you're creating corporations, they have tax returns that you may not be used to doing as a housing authority. Housing authorities do not have tax returns. So if you create a nonprofit, there's a 990 filing requirement. No matter how much money you have, you could put nothing in there. If you create an entity, it has a filing requirement. It's called a 990N postcard. It's really simple, but if you miss that filing deadline, all of a sudden you lose your nonprofit status. And we see people all the times too, like Doug was saying, they use the attorney to create the nonprofit, which is fine. But a lot of times they only create a corporation. They forget to do the 1023 and get the IRS approval for being a nonprofit. And they go around thinking they're a nonprofit and they've never finished and not recognized by the IRS. And that causes problems down the road when you go to get a grant or something and they go and look you up on GuideStar and you're not there. So I guess my words here would be, if you're going down one of these things, if these words are floating around your organization, talk to your fee accountants, talk to your auditors, or call us. Sometimes I know some people on here aren't our clients. So if you need help in this area, like Doug was saying, use that 61 tree. Good luck if you don't know accounting really well reading that. We have a hard time. We discuss it sometimes reading that 61 checklist. It's not a piece of cake checklist, but have that discussion, hash it out, and come up with a decision on where these things belong on your financial statements well before the reporting period. Because there's nothing, I guess one last thing I'll throw on here. I know we're running short on time, but nothing worse than you not putting a component unit on, then the auditor coming in and determining that the audit component unit has to be put in on your FDS, because that raises all kinds of questions to the REAC reviewers who approved your submission with no component units, and now suddenly you're adding a component unit. It throws the financial statements kind of out of whack. So it's always best if your unaudited matches perfectly to your audit. I know that doesn't happen all that often, but it's nice when it does.
Yeah, and just lastly on these component units, if you're getting into, like, for my California housing authorities, if you're working with Cal, HCD, or any of these guys, and you get these loans to start up a project or rehab a project or anything like that, you need to read that regulatory agreement, because they're going to want a separate audit. Right. And same thing with HUD. If you're getting into a PBRA deal, PBV, you're not going to need a separate audit, but PBRA, you're going to need a separate audit. You're going to have a multifamily housing submission with it. Right. So you take these funds and you take these loans and you set up these new legal entities, and you don't read through the regulatory agreement and figure out, hey, they're going to want this report in accordance with their Cal HCD, reporting guidelines, right? And that's a completely separate audit. That can't be just part of the audit that we do normally for your housing authority. There are separate standards and reporting and different materialities. There's a lot of work that goes into doing a completely separate audit for Cal HCD or for your PBRA properties.
Right, so, and they don't buy off on the idea that, hey, it's audited by Doug inside of the housing authority. They go, no, we want to, especially that Cal FHA stuff. They want a whole separate, broken down, just that project they lended money on. They want a separate, just that picture.
Yep.
All right. Off our hot topic, on to the next one. Oh, a quick one here too. I forgot we had a slide in here just to make sure everyone knows the life of a component unit. This is mostly talking about LIHTC deals, but even a nonprofit, doesn't matter. There's that first step where you're creating it. And we were talking about that. That's where you want to get us involved. We usually don't get involved until the second step, which is already kind of late because we didn't help you with any of that first step, or I'm not just saying us, your auditor or someone knowledgeable in the nonprofit component unit area to walk you through those different reporting requirements like we were talking about, where you might have a separate audit now required, you might have a separate tax return. All that's good to know when you're doing that step one. And a lot of times we don't get there until step two, when you're now you've got to notice that you're late on your audit report for this entity, or your tax return hasn't been filed, and you send it to us and go, Chad, Doug, help. And we go, oh man, I wish you would have asked us back at step 1. It would have been a lot easier and a lot cheaper to fix. And it stays in step 2 for a long time. It operates like a LIHTC deal, usually operates for 15 years. And I have a lot of them going into step 3 where the dissolution comes along. A lot of LIHTCs are coming back. You know, this 15-year period is up and the investor wants out. You probably want to talk to us again about that part. We're a disinterested party. I'm not trying to make money on whether you bring the item back in or you re-syndicate it. Developers and other people like that do have money coming from whether you do one item or the other. We just try to walk you through and tell you, you know, what's a good deal, what's a bad deal, what's reasonable, what's not reasonable. Sometimes it's reasonable to pay $5 million for a building that's worth 20 million. Sometimes it's not. There's too much debt on it. There's no revenue stream for it, so you don't want that property back. You may have to pay exit tax, and you may say that doesn't sound fair, but a lot of times exit tax are fair. So if you're hearing those terms thrown around and you're kind of lost, you probably want to talk to a fee accountant auditor that's familiar with this area and make sure, you know, the housing authority who's doing this once a year, once in a lifetime, doesn't make some bad decisions that we have seen 15, 20 times. Use our expertise, call us up. That was the only one to do on that one, just because we harped on step 1, but I forgot there's step 3 too, that sometimes my housing authorities will take back properties they shouldn't have taken back. They'll end up paying way too much money for something. So just be careful in that area. Yep, everyone's still confused on how to report. So let's talk a little bit more about CARES and how to report it on the FDS. Sorry, I have to move I got all of our little faces right on our screen where we're talking here. The public housing one, you know, the big deals we're talking about, this is kind of rehashing it again, because it is, like we said, big rejection areas. The ELOC system, they know how much you pulled down. They have access to the ELOC, and they're going to know that you pulled down $1 million or $100,000 or $50,000 or $10,000. The threshold really doesn't matter. I've had someone with $500 pulled down that caused problems. They're going to look, and they expect that to be in the FDS submission. And you know, it's kind of like CFP. If you've ever listened to our seminars before, we try to tell you, and CFP is like a 3-day, like a 1 or 2 day turnaround from the draws. Can you just draw on your year end a day or two before year end so the cash comes in the door and we don't deal with AR? AR just complicates it with the reviewers. Sometimes they don't understand that they need to take the revenue plus the AR or minus the AR or plus last year's AR. It gets them so confused when there's accounts receivable. If you can, it's an ELOC system. It comes down really fast and easy. If you're June 30, pull the money down June 27, June 28, you know, December 31, go pull that money like 26 or 27. Don't wait till the 31st, or worst, go to, you know, the 1st or 2nd of the next month and pull the money down and set up as AR. Just makes your accounting life easier. Revenues, the 706 should equal the ELOCs. That's what they're going to go look for. And it makes it easy if you don't have AR. It ties right nice and neat. As auditors, we can see it. As reviewers, they can see it. No problems. And again, capital purchases, you got to show that transfer. You can't have net income, can't have a net loss in these programs. Anything else I'm missing, Doug, on that one, on the public housing CARES funds that are really causing problems?
No, it's a reimbursement grant. So, you know, your revenues should match your expenses unless you're doing capital purchases, like Chad said. So those two should match. You shouldn't have cash because you draw down what you used, and you shouldn't have, and hopefully you don't got AR. So
yeah, it'll make life easier if you don't have AR. But we know some places that's the way they work, especially larger agencies. They have a harder time with that. But smaller agencies, I would try to stay away from the AR. Okay, I think next one's 14 HCC. Oh, we just threw them all together. All the rest of them, because these are all kind of tied together. They're all kind of the voucher. Don't make the mistake of putting them all together. They do have to have separate columns in the FDS, but they all have similar problems. That's why I kind of lumped them all together on one slide here, is that, you know, these ones, they are dropping the money in your bank account in advance. Remind me, Doug, I think May and August. Was there another round after that? That was last year. I'm not sure if they've dropped any more money in recently.
Well, the EHV money just came like
yeah, the EHV money, that's right, June. So you would see that money coming in June 2021. So like we were saying before, when that money comes in, you really should record the initial deposit into restricted cash and unearned revenue, and then do the legwork and move it as you spend it out of, you know, cash and unearned into revenue and expenses. And again, like we're saying, the revenue should equal the expenses. No net income here, again, other than purchases. And then they do know that they should take the 706, should equal the expenses plus the capital asset transfers. Don't guarantee if I have capital expenditures on either of these, public housing or HCV, I would definitely, like Doug said, open up that comment section and make a comment. Hey, I spent $100,000 of CARES funds plus $20,000 of capital assets that were transferred on the equity line, blah, 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 to show them I spent $120,000. I wouldn't rely on them to make the calculation I'm showing right here. I would just, they're doing a lot of reviews and they might just skip over it and go, oh, it's wrong, and mark it off. So if you show it to them, at least you get a fighting chance that'll be in there. Yep. Anything else I'm missing on those ones? 14-point HCV, yeah, EHV really shouldn't have anything in the June 30 reporting period other than cash and.
Yeah, not yet. Just, I know we're talking about REACT right now, but just another report is going to be your statement of expenditures of federal awards, your CFA. And so on your CFA, you're going to have multiple lines under like your 14.871 if you have these care funds, right? You're going to have your normal HCV program money, and then underneath that, you'll have your HCC money, which would say CARES or COVID-19, you know, housing choice vouchers. And then underneath like your 14.879, your mainstream. So you'll have regular mainstream, and then you have COVID-19 mainstream. So under your HCV program, you're going to have this 14-point HCC, and you're going to have this 14-point EHV. Both of those are going to go underneath and sum up to your total 14.871, right? So all of these numbers are HUD made up CFDA numbers. They're not actual CFDA numbers that you're going to be able to show in your clearinghouse, or you'll be able to show, you know, on your CFA, right? So you're going to have to figure out under which actual CFDA numbers do these go, and they're going to want the breakdown of the different. They're going to know how much is your regular HCV, they want to know how much is your COVID-19, and they want to know how much is your emergency housing to add up to that HCV program. And then the same thing when you input the information into your clearinghouse, you're going to have to put in 3 times, you know, your section 8 grant. You're going to have regular, you're going to have to explain that the next one is your CARES, and then one's going to be your emergency housing voucher. So it makes it fun for doing your clearinghouse submissions and your CFAs.
Kind of go over the 14-point COCC kind of quick. Actually, that's wrong. I think it's CCC, isn't it?
Mm-hmm.
Yeah, sorry, that's my typo. I can't spell that well. I do numbers good. I don't spell that well. On this one, the big deal, I would say on here, because we're getting down towards time, revenues, there is no 707 line in the CCC. They couldn't create the line, even though it really is management fees. You have to put in line 715, which is other miscellaneous revenue. There's nothing they can do about that. So just know that if you even read the PIC notices Doug was talking about, the PIC notice will tell you to put it on 707, but I can guarantee you, and Doug will tell you too, you go in there is no 707 line. It doesn't exist. So just know you have to put it on 715. 715 should obviously equal the 920 lines, so that's where you put the extra expenditures that you're having in the COCC. You need to put them all in 920, because any regular expenditures you have should be just in the COCC. So it's a little different on the COCC funds that you're getting. So just be careful with those. Mostly my large housing authorities are the ones that are dealing with the CCC. Before we jump to moving to work, Hannah, do we have any questions?
No questions. You guys can just keep moving along. Okay.
MTW, moving to work. This one, if you just go to the next slide, I just want to talk a little bit about MTW. I'm not anti-MTW, but I just like to make sure that everyone knows, hey, when they sell MTW to you, and when I say they, HUD, analysts, people like that, tell you about all the great time savings you're going to have on the program side. And we go, that's great, you are. Don't dispute that. I don't argue that. But remember your poor accounting people. We're going to be doing a lot more work. Your auditors, your fee accountants, and even your internal accounting people will have to do a lot more work to track the accounting of it. It frees you up program-wise. It makes a burden on the accounting side. And again, I'm not telling you not to do it. I'm just telling you, well, kind of like the component units, plan for it, allow for it. Don't just think you can keep the same accounting structure that you have and it'll be fine. You're just moving to MTW. It'll be no problem. It'll just make it easier for my program people. You're going to have to restructure your accounting system to work inside of MTW. Because HUD, even though they tell you that it's all mixed together, the revenue streams, it is for compliance side and the expenditures of how you can use the money, but they still want you to track inside of MTW how much of it was HCV, how much of it was public housing. And if you want more detail on this, we had a whole seminar for about 2 or 3 hours where we talked about this in detail with a person who does MTW, a CFO at a housing authority that did the MTW stuff. So reach out to us if you want to get more information on. We have that whole seminar. But just in short, there's a lot you have to track on the revenue side to make sure that you can report back to HUD 2 to 3 years later, which is when they ask the questions. It's not last week. It's 2 to 3 weeks, 2 to 3 years later. They say, wow, back in 2018, how much did you have in HCV from MTW? And a lot of my clients, including that person that was on there talking, was they thought they just got to slam everything together in MTW and figure out how they wanted to do it, which is the idea behind it. But HUD, some reason, still wants to know how much funding did you get from the HCV Public Housing Capital Fund portion of MTW. So when I say you need to track that, you got to set up your accounting system so you can still see that inside your MTW funds. Your expenditures, that doesn't change too much. If you listen to that seminar, it's not too difficult. But the MTW program has a lot of transferring back and forth. The money flows into MTW. It's transferred out to either a HCV, a public housing, or a capital fund. How you see fit, that's the big deal about the program, is that you can now use excess funds wherever you want. So you don't have these big reserves sitting in public housing that you can't use over in HCV. You have the great ability to move and do that. But you have to track all of this through those transfers. And the big deal is make sure you don't make the mistake of, oh, I transferred 100,000 in, but then I transferred $8,000 back, and netting those together and just showing a $98,000 transfer. You need to show 100 transferring in, $8,000 transferring back out. Yes, I know that's a net change of 92, but that is important when it gets to the REAC submissions and reporting and HUD, is that do not, put them together, combined transfers in and transfers out. Keep those very separate. I know it's a lot of extra accounting. You're going to hear groans from your accounting people. It is extra work. Make sure they have the resources to do this extra accounting from there. And then on the last part on here is the CFA, the Schedule of Expenditures of Federal Awards. Pretty much everything's going to go under the MTW SIPTA number. And you really probably, I say these in general terms, you won't have public housing, you won't have HCV as a major program anymore. For anyone who's an auditor here, makes it really fun because now you have one big pot of money that has multiple compliance points. Before you were testing HCV, it had its HCV compliance points. You were testing public housing maybe the next year, and it had its compliance points. But MTW takes all of those people and puts them into one pile, and you have to audit that population that way. So it does cause some problems for your auditors. It makes a little extra work for them. So I guess the way I always tell everyone about this is that you've been sold all the great stuff about MTW. Well, let me tell you some of the dirty secrets about how it is a little bit more work. Still a great program. You get you can't beat the flexibility you have with it. Is just be aware of the extra accounting that you're going to have to do and extra reporting you will have to do to satisfy HUD after you do all that great shifting around and serving all your clients with the money the best way you can. You just have to then account to HUD for that. I don't think you have anyone on an MTW, do you, Doug?
No, I don't.
Yeah, so that's kind of my spiel on that part. I've still got 7 minutes left if we have any questions or anything else. Oh, sorry. I guess I thought I was done, but program restrictions. Yeah, I guess I just kind of said that. What I was saying is the program restrictions are a trade-off for your reporting new things. So all that time you're going to save over in program, just be able to reallocate those resources over to help the accounting side because they're going to need a lot of assistance on the tracking and planning for it. And you definitely want to give them gear up time. to get the accounting structure set up and go to training on this, and maybe have someone come in and help them structure their accounting so that they're ready to go running off with this program, because it'll work good once it gets going. So we kind of gone over a little bit about some of the new columns you got to add in your checklist and common errors that we've seen. We talked about the component units. Please, 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 just if you're going down that route, if you hear those words, any of those buzzwords we said, you know, just I hope that red flag pops in your head. If you don't get anything else out of the seminar, call your fee accountant, call your auditor, call somebody that go, hey, I heard these buzzwords. I want to make sure I'm doing this right. And then MTW, you know, you're going to end up with, you know, additional accounting work. So make sure you plan for that. Kind of like we have to plan for extra work when you have component units. Now I think I'm at the end where we can do questions. Yes, thanks for everyone for attending. If you have questions, you can always, a lot of clients will have our email, Doug or I's. You just have to, you can use the smco.cpa. Notice that we did change that for long clients. We have gone to just smco.cpa. We're no longer, you can still email us at smcocpa.com, but we're trying to get everyone to switch over.
Yeah, huge thank you to Doug and Chad for your time today. Also, big thank you to everybody who attended. At the end, when you close out, a survey will pop up and you'll get one sent to your email. Feel free to scroll to the bottom of the survey where it asks if you have any additional topic requests. Even if you skip anything else, if there's anything you're dying to hear about, put it in, because we do look at those and we do take those into consideration when we're deciding future topics or even future articles. So just keep that in mind. Like I said earlier, this was recorded, so you will be getting the recording. Feel free to pass that along. If you have a coworker who this would be, you know, interesting to, or you have somebody you know who this could be beneficial for, absolutely pass that along.
Otherwise, I think you guys get out 5 minutes early, right?
4 minutes.
Well, I had you 5 minutes. It was Hannah that cost you that extra minute. Thanks, everybody. We'll be in Florida next week doing some training. So if you're able to attend the Florida one, there's Doug and I will both be speaking there. And then I think the week after that, I'll be, or 2 weeks after that, maybe we'll be in the Tennessee Housing Association speaking on a couple of different events too. So hopefully if you're able to make any of those, we look forward to seeing you there in person.
Absolutely.
Thank you.
All right. Thanks, everybody.
Thank you.